everyone. Good morning and welcome to the market. I'm Avan Dabash and with me is Nikunj Dalmia. And yes, indeed, that relief rally did play out on Wall Street, and that's hopefully the cue that we should be piggybacking on. But for our markets yesterday, while the attempt to pull back was very evident, 17K still didn't really make it as we wrapped up sub that mark, with the broader markets as well seeing a cut of about 1%. Lots to take cognizance of. The fact that we have seen the broader markets, global markets rather, staging that relief rally. You had the Dow, which rallied about 380 points. The S&P 500 gained about 1% or so. And this coming in a day after that forced action or takeover of Credit Suisse by UBS, and also the news that JP Morgan will be advising First Republic Bank on strategic alternatives. So while the banks bore the brunt of the selling pressure, for the rest of the markets, you did see that rally play out. For the Asian screen this morning, you do have a little bit of a mixed basket. For example, the Nikkei is down about 1.5%, but the rest of Asia holding out in the green, and that's the SGX Nifty as well, indicating that it could be a potential positive start for our own markets. But there's a lot that we're digesting and looking forward to as well, Nikunj. The fact that there is going to be the Fed meet later this week, whether or not they're going to pause on those rate hikes remains a huge question mark. And we've seen crude oil prices as well go sub that $70 per barrel mark. Gold is rallying as well.
Yeah, it's a disjointed world, Avan. Yeah. Gold, Bitcoin, crude, expectations from US, FOMC. Frankly, next 24 hours and 48 hours, the entire narrative would be centered in and around what indication we will get from the US Fed. If the US Fed increases interest rates, then the concern is that that will only have an impact on the bank's balance sheet because of M2M losses. But that also is an indication that US Fed feels that the US financial system is resilient to digest another rate hike. But if they don't increase interest rates, that also could be a signal that the US financial system cannot absorb any more rate hikes. And despite high inflation, they've been forced not to consider a rate hike. So really, depending on whom you are asking, you will get a very different kind of an positioning. When it comes to specifics, I don't think the storm really has come and gone. In fact, if you ask me, the storm in Mumbai just arrived this morning. It's cloudy and it's raining. We'll talk about it. Very unusual to have rains, at least in the month of March, but it's raining. So really hinges on the next 2-3% move for global markets will be a function of the Fed commentary. And there you go. Yeah, it's Mumbai for you, my friends.
It's March, Nikunj. Who would have thought that we'll be taking out our umbrellas in March? As that's the scene that's playing out. Do remember the IMD had spoken about some showers in New Delhi, etc. But that orange alert in Delhi, but perhaps Mumbai, that's come as a bit of a surprise. What didn't come as a surprise is the fact that we didn't really manage to stage a rally yesterday. If we can pull up the intraday chart of the index, because 17K still eluded us. The broader markets did come under pressure. A lot of the rate sensitives felt the heat. We were 140 points off the lows, though, by the time we wrapped up. But the net selling from FIIs, that continues to remain 2,500 odd crores. You had FMCG as well as that really managed to stand out in an otherwise dull market. So, for example, HUL, ITC have been the top gainers. And as I said, high beta really came under pressure. So metals were the top losers. Global growth concerns continue to plague, and banks really bore the brunt of selling. But Nikunj, yesterday actually, Kunal was talking about this fact that maybe things are turning around with the fact that at least defensives are now seeing a bit of a pullback. Otherwise, they too came under the tide of selling pressure. The fact that they're managing to hold out gave us a bit of glimmer of hope yesterday, at least.
So, Avan, you have to understand that there's a compulsive part in this market, and the compulsive part in the market is perhaps centered around the fact that FIs are selling not because they want to sell, but they're selling because they've got redemptions or they've got compulsions to sell. So the price action, let's say in a Reliance or of late what we've seen in HDFC Bank or even for that matter TCS, this really smacks of the FI selling. FI short selling right now is at a record high, which means the positioning of the market is such that either FIs are selling in the cash market or their positioning is the positioning in the F&O market is at a record high. So that just tells you the kind of nervousness, stroke, the anxiety, or the entire pattern is there by foreign institutional investors. Now, what do you do in this kind of a market? Well, you will typically see that from high leverage plays, which is financials and infra, markets will migrate back to companies which in a sense have strong cash flows and give you visibility for next 2-3 quarters. And given what's happened to commodity prices, I guess there is a rotation rally which is visible in commodity consumers. So the HULs and the Nestles of the world may see some more outperformance, given that A, they are defensives, B, commodity decline I think is real, and C, the incremental benefit of some of these companies after 2 years of drop in commodity prices I guess is real. All commodity producers have benefited in 2021 and 2022. I guess the reverse trade clearly is at play now.
Yep, that clearly seems to be the case. But let's talk about index levels then as a whole and just try to understand what exactly the word is from leading brokerages. For instance, BofA has come about and they've cut their Nifty year-end target. So earlier it was 19,500, pardon me. Now the target on the Nifty has been reduced to 18,000. In fact, the categorical word is that one should look at buying the Nifty at around the 16,000 mark. The lower range of the Nifty is 16 to 18,000 and flat returns in CY23 are expected. Valuations as well are close to the long-term average according to BofA, and they've also said that the Nifty is still overvalued versus emerging markets as well as debt, saying that a 6% correction to Nifty will make it attractive in terms of buying for a dip. And looking at the Nifty, Nikunj, in terms of buying levels, BofA is talking about how a 6% correction would make it attractive, and they've clearly slashed their target prices. Do you think that, a slew of other brokerages will come ahead and do the same?
The series of earnings downgrade has started. If you remember, when we started the year, every brokerage, in a sense, the consensus view was that 2033 would be a flat year, a year with no returns. Now, there is a markdown, and BofA ML is the first brokerage which has come with a markdown. Now, there is a belief in the market that typically when the brokerage cuts they start, that means that we are nearing the end of the decline, because brokerages in a sense are indicating what markets have already priced in. Frankly, if you look at the market price action this year, has been on the weak side. Benchmark indices are down about 10% in absolute terms, in double digit in dollar terms, which means Indian markets are no longer the expensive market. And in terms of the positioning of historical averages versus the current level, we are not far away from its long-term historical averages. Will we go there? And should one wait for it? I guess that's anyone's guess, simply because you cannot preempt in the near term, because of the compulsions in the global market, what kind of price action we should anticipate and expect. But yes, this is the first big brokerage downgrade which has come. It really could be first of the many brokerage downgrades which will come, because what assumptions were at the beginning of the year, let's say Jan 2023 versus March 2023, there is a sea of departure. Having said that, somewhere we need to be cognizant of the fact that crude is down, down, down and down. That is something which needs to be factored in going forward. Santosh Rao joins us now. Let's connect with him, Head of Research and Partner with Manhattan Venture Partners. Good morning, Santosh. Thank you for joining us.
Morning.
It's cloudy and hazy, at least in Mumbai. It's raining. But if you have to look at the Wall Street, is it looking cloudy?
Is
it looking cloudy or hazy? Do you think sun's not going to shine bright?
I'm sorry, can you say that again?
No, I'm saying the weather in Mumbai this morning is cloudy and hazy. But if you have to use that analogy to talk about the mood point on Wall Street, is it cloudy? Is it hazy?
No, actually, it's not bad. I mean, it's springtime here, so things have to open up technically. And I think the market is kind of in a holding pattern at this point. We're waiting for this big Fed meeting, which is the mother of all Fed meetings, because we really want to know what they're thinking. Are they still sticking to that higher for longer narrative, or are they going to tone it down, raise it 25 basis points, show the world that, hey, things are not that bad, still under control. We're just fighting inflation and tight job market. So they're staying on that mandate. So no need to panic. But if they don't raise, they're going to raise the alarm bells and show that things are really bad and we need to do something. So I don't think they're going to go that way. But whether they'll start cutting after that, I don't know yet. The bond market is showing that. They're saying, hey, the rate cuts are coming down the road, and so it's the rates are coming down. You see the 2 year, the way it's acting. So overall, I would say there is recession expected down the road. It's not a very happy mood, but it's not gloomy as yet. It's kind of on a holding pattern at this point.
Fed increases rates. Is that endorsement of confidence that the US financial market can digest another rate hike? Should we look at it constructively?
Yes, I think we should because there is inflation. It's quite high. There is wage inflation. There is services inflation. The job market is still tight. And the whole exercise of doing these raises was to control and bring that down. And if they just turn course and start not do anything or lower the rates or whatever so early, it's not going to be easy to raise it back again. And then we are going into the political season next year, the presidential election. So it's not going to be easy to go back and forth. So I think they're going to stay the course. Maybe they stay there longer, around 5%, and not do anything and show signs of maybe we might start cutting down the road. So I think his press conference this Wednesday after the meeting is going to be very important. People are going to parse every word that he says. Because we did go through some real scare here in terms of the banking, the liquidity crisis that we saw here in the US. Of course, the Europe is a whole different story, but it did spill over into Europe as well. But I think the thing that we saw, it was really localized. It was a very idiosyncratic thing, but it was a systemic risk. But nonetheless, people did get scared. And so there was a little bit of scare. So I don't think they want to shake the boat too much, but they want to say that, hey, we are on track. Don't worry about it. We have it under control. And that's what a 25 basis point will show, that we can absorb it. We need to do it.
But will they just simply kick the can down the road by doing a 25 bips? Because the problem is that banks and the balance sheets which have got large unrecognized or unbooked treasury losses, if interest rates they go higher, eventually they will come and hit the balance sheets of the bank. So while Fed may do their bit in order to calm the market down, but that's like kicking the can down the road.
I think the big banks are well capitalized. I think that's been the saving grace throughout this whole crisis. They're very well capitalized. There is no credit crisis anywhere in sight. So I think that the ratios, capital ratios, are very good across the board. So I think, and the big banks have leveraged, they have the money to hedge themselves against the interest rate risk. So, and they knew all along. I think the small banks, that's where they went wrong. The very small banks and the regional banks also, they did not do sufficient hedging against this interest rate hike. And that was the issue. So I think at some level, was it a supervisory and managerial lapse as opposed to any systemic thing? I think that's what people will look into. And people are really looking into that because they feel that that's the first thing they should have known, because interest rates are going up. So they should have hedged it more and more. But anyway, that we will find out more and more down the road. I think the big banks have no issues with this. They will manage it. At some point, the rates will start coming down and the unrealized losses will come down. And they have enough liquidity to manage that risk at this point.
Do you believe, Santosh, that the worries of, this contagion effect of what we've seen play out in the banking space is going to play out? Is there a worry of that right now?
Well, in the US, I mean, this fire was contained very well in a timely manner, but there are some underlying issues. The commercial property loans, all those will start coming due. There are already issues about work from home and properties staying empty, and some of the big builders, and they have reneged on some of the payments. So I think there are some underlying issues going on there. Hopefully that doesn't swamp the banks and cause any issues at this point. But we'll wait and see. That's something to be watched closely. I don't think there's a contagion yet, but it cannot be ruled out down the road if the commercial property loans and all that becomes a big issue, and these banks cannot handle it. The what do you call, the uninsured loans that these companies have, or the deposits and all that. Those are issues in the regional banks and the smaller banks that may become big issues. But there is a lot of talk going on about mergers, acquisitions. So there's going to be a lot of M&A activity to absorb these small banks because they're selling at a very deep discount. So there's a lot of activity going on. So at this point, there's no risk of a contagion. There are some underlying issues that need to be watched closely, but we will wait and see how that plays out over time.
To go on that note, thanks very much for taking time out and joining in, giving us a perspective on all that's going on in the US and the rest of the world. But speaking of the rest of the world, you had the Japanese Prime Minister Fumio Kishida, who met the Prime Minister Narendra Modi. And of course, bilateral talks were held. This is a visit, a two-day visit to India that has been planned with the Prime Minister for the G7 Hiroshima Summit. He went on to say that India and Japan can work together to ensure the rule of law on the international forum. And not just that, we also saw the Japanese Prime Minister giving his taste buds a solid, flavorful try. As Nikunj, it was golgappe, lassi, all of that he actually managed to enjoy.
This is something which I really miss about not being in Delhi. Trust me, the Delhi golgappas are much better than what you get in Bombay.
So we have to give it a try then. Yes, absolutely. So that is the Japanese Prime Minister, and clearly enjoying all of those Indian delicacies as he was eating golgappe, lassi and ampanna as well. All right, moving on and away from that, let's talk about the Indian equity markets. There was no sweetness there whatsoever, given the fact that it was sub that 17K mark. Let's connect with our chartists then. Kunal Bothra and Nooresh Merani joining in. Morning, gentlemen. Looking at the screen, Kunal, what is the outlook on the markets, given the fact that, yes, that rebound has come about, a relief rally of sorts that we witnessed on Wall Street. The SGX Nifty is indicating as well that it could be a higher start. What are you penciling in on the index?
Good morning, Avan. So I think it was a good day for the markets yesterday. When we look at the second half specifically, the recovery which panned out across the board, Bank Nifty making a very strong comeback, individual sectors. So, what was the missing link in the last 4 or 5 days? That there was hardly any strength from any major sectors in the markets, let alone be, the likes of defensives, like the pharma and the FMCG. Now, that's one sign of stability which has come back again, that there are at least some sectors which are trying to make a clawback again, like what we saw, for example, yesterday on the FMCG part. Large cap names recovering from the intraday lows. Now, the key data point which I looked at the index data, especially the derivatives, was yesterday, that there was a huge amount of writing at the 39,000 put options on the Bank Nifty. Now, for a brief period yesterday, the Bank Nifty fell below the 39,000 mark, but then I think there was a very strong bout of short covering on the put writers, and that I believe has led into a strong recovery for the index yesterday. And same would be the case for the 17,000 puts today on the Nifty, because yesterday in the closing there was incremental amount of writing at the 17,000 puts, which means if the markets open up 70-80 points higher, and if there is an additional writing at the 17,000 puts on the index, we could be looking at a higher base. So earlier we were discussing of 16,800, 850 as a strong support. Assuming if we manage to trade with a positive bias today in the first half, then we could be discussing of upping the base to 17,000 on the Nifty. So the bias remains slightly bullish, and expecting 17,000 to be a broad support for the day today.
Hi, Nooresh. Let's get in your take as well on the markets in terms of what you're working with when it comes to levels on the frontline index, given that all the high beta pockets really felt the heat, but defensives like FMCG managed to hold out.
So overall, yesterday was a day where we at least saw some bit of recovery again by end of the day. The FMCG pack did well, but overall what we need is more support coming in from the heavyweights. 16,800 continues to hold on, and now 17,200 remains a price point which actually makes the pivot in terms of a momentum shift. It's when we close about 17,200 we can call a short-term bottom being done, and we could go towards 17,600. Now going forward, after say tomorrow, we have on Thursday morning we'll see the impact of the Fed policy, and that could be say an overnight risk going forward. But overall from today, I would be positive for the day, closer to 17,100, 150 being tested today. And overall, post the policy, we can see a further trend. But 16,800 continues to hold on, expecting momentum to continue for the next couple of sessions and then post the policy.
10 days of Nifty, and we'll mark out the importance of 16,800. Why is 16,800 important? Well, we've discussed this yesterday. That's yesterday's intraday graph. Let's look at the last couple of days, and there you go. We're looking at 16,800 in a sense acting as a base. Kunal, is this one of those levels which will make as a durable trading bottom for next couple of days? Because now things are falling again in favor of bulls. Markets extremely oversold. Global Qs have stabilized. The FNO position in by FIs is at a record high, and the VIX also has shot up in last couple of days.
You've hit the nail on the head. Most of the factors which we tend to look out for, the drop in volatility index, or at least the curtailing of the rise in the volatility index, sectors making a comeback sooner or later, the demand for the index at a particular level. So look at it this way, that from I think the last 8 or 10 days, when the markets fell sharply from those 17,800 levels to 16,850 approximately, it was almost like a very sharp correction, no major recovery which was happening. But in the last 3 days, the markets have gone to an intraday recovery. So yes, there have been intraday corrections where the Nifty has managed to break a new low on a marginal basis. But the recovery at the end of the day indicates that there is demand for the index at current levels. And I believe that's the most standout feature. And that indicates that 16,800 is a very strong support zone. And Bank Nifty yesterday apparently did not make a fresh new swing low. So that's also an indication that there is a strength which is happening in the relative sectors as compared to the benchmark Nifty. So all of that indicates that there is a bullish divergence setup which is happening across the market breadth. That I believe is a very strong sign. So yes, 16,800 should be a broad support, and my sense is that this support should hold on in this leg of recovery.
Nooresh, will you buy the Nifty first thing this Tuesday morning? I mean, just go and buy the Nifty. Trade for 200, 300 points, maybe more, but buy the Nifty today.
So I expect a bigger gap up, so it would become difficult. Say if it's a 50-60 pointer gap up, yes, I would buy.
Let's get in those stock recommendations then, Nooresh. What are you picking out for the day?
So going with the heavyweights today, first would be a buy on Infosys. The stock has corrected from 1600, 1650. The lows were around 1350 to 1400 for the last 6 months. Expecting a bounce back from here at least towards 1500, a stop loss at 1380. Second is a buy on L&T, which continues to be a stock that can break out going forward. 2200, 2220 has been a resistance for the stock. A lot of relative outperformance by not falling over the last few weeks. So at current levels, after yesterday's dip, it makes a good risk reward. A stop loss at 2140 and a medium-term target price of 2500.
Let's find out what exactly it is that Kunal is betting on in this market. Kunal, your fresh ideas this Tuesday morning.
So a couple of buy calls focusing on large cap names. So going a bit contra in terms of the approach. The first one is one ITC, the stock which has corrected from 394 to I think around 365, 370 levels. So looks attractive from a contra perspective, and would expect the stock to get into a recovery. The FMCG sector itself has been looking quite strong. So would bet on ITC, targets of 400, stop loss at 360. And SBI is also a contra buy. My expectation is that the stock probably has bottomed out at this 500 to 520 support zone. So keeping 509 as a stop loss would suggest a buy, 540 as an immediate target.
There you have it, all your top recommendations that our chartists have flagged off. Well, let's move on to a big market call. The word coming in for Ravi Dharamshi, CIO at ValueQuest Investment Advisors. He believes that the energy transition is going to be the next big theme going forward. Listen in.
I think energy transition is a huge theme. See, and it is not anymore driven only by regulation. It is driven by economics. Solar today is the cheapest source of power available anywhere ever. Okay, we have not had this cheap power ever for humanity. And now the beauty of it is available most of the places in the world. It is not restricted to few geographies like it is in the case of coal or crude for that matter. So this is a democratization of energy, and it will have far-reaching geopolitical impact which we cannot imagine today. There are so many wars have been fought because of limited resources, and now suddenly energy is not going to be that factor. Energy is going to be available. I'm talking about 10 years, 20 years from now. So it is a huge trend that has started, and there is a global push. See, there is on the S curve, there is a early adoption and it's good to have kind of a thing. But once it reaches a particular inflection point, then it becomes a mass movement. And I believe solar has already is way past the tipping point everywhere in the world. US has just begun because of the Inflation Reduction Act, the kind of incentives they have given to the green economy. It is going to provide further push. And solar is actually the backbone of all, because to convert any energy into clean, you need solar at the back end. Yes, solar might not be the best in terms of efficiency. For every I mean, there is only 25% retention in the overall scheme of things. But it's undeniable that the solar penetration is here to stay. The problem in India is that there are very few ways available to play this theme. And hence, I mean, whatever limited plays are available, we are trying to get them. Vari, in fact, is still an unlisted company. And so we brought companies from the listed as well as the unlisted space. Praj is on the biofuel. A lot of people consider Praj or the food versus fuel debate and it not being a very desirable thing. But as what we believe is that humanity is facing a real big crisis, and this is all hands on the deck approach. It is not about this technology is better and this is slightly worse off in the medium term. You have to deploy anything and everything that is available to ensure that the dramatic rise of the temperature in the world does not go beyond the tipping point. So we have to put everything that is available. And also, it is not a one size fit all. Some country might have a huge agri waste, and that is a good thing. You know, people, you can generate energy from it. Sure. So finally, it is about capturing the solar energy. The plants have been doing that since forever. We are only converting that energy back into a usable form. Either it is in terms of fuel or it is in terms of electricity. So I sincerely believe that energy transition is a mega trend.
Welcome back. Let's focus in on all the stocks that will be in news this morning. Well, brokerage notes coming in fresh, and Phoenix Mills in the spotlight as Motilal Oswal has got a buy rating, and so has Antique. This is on Venus Pipes. Let's understand what exactly both these top brokerages have to say. We've got Harsh here with those notes. Morning, Harsh.
Well, good morning, Avan. So, good couple of solid notes coming through. Motilal Oswal's initiated with a buy, and 30% plus upside is what they see in the stock. 1700 is where they've placed their target price. They expect the company to deliver a 34% CAGR in EBITDA with regard to their rental portfolio. Now, mind you, with regard to their rental portfolio is expected to expand from the current 9 million square feet to around 14 million square feet by FY27. So you are seeing a sizable increase even in terms of the portfolio size and composition. With regard to the consumption story, they believe that the retail portfolio is reporting a steady recovery with regard to consumption. So that's a positive as well. And on the back of that, we will keep our eye out on Phoenix Mills. With regard to Venus Pipes, Antique has initiated coverage with a target price of 1,037 rupees a share. They believe rising volume and backward integration will drive profitability going forward. They believe that there's credible stainless steel pipe and tube manufacturer demand as well, and this is quite a sizable player in that particular market. Venus only manufacturing plant having a total cumulative production capacity which is large, and the expansion would raise its capacity by 33.6 KTPA along with the backward integration positive as well. So they're positive. Antique is positive on Venus Pipes on that front as well.
Pankaj Pandey joins us now. Let's take our conversation forward. And Pankaj, looks like we are in for a good day of trade finally.
Yes. Hi, good morning, Nikunj. Thanks for having me. But our sense is that, given the fact that US is facing issues on the financial stability side, probably one bigger challenge could be that if the prospects of hard lending has sort of improved or has increased, and that probably might lead to even more higher volatility, even subsequent to the Fed meeting, which is anticipated this week. But the good part is that in this entire volatility, our sense is that typically the bottom formation for market should happen. So this kind of a slow pain, which we have been experiencing for quite some time, I think is probably inching towards a logical end.
Really could be slow, But markets typically bottom out when you see a sudden crack, a lot of capitulation, a lot of panic. Stocks have to fall 5, 10, 15%. Historically, market bottoms are made when there is panic, not when there is a slow grind.
Which is what is our expectation, Nikunj, because if US banking were to sort of, or the economy were to sort of head into a situation of a hard landing, I think that is, then there is a possibility that you might see a sharp volatility and probably a panic reaction. We are already seeing anxiety levels being quite high across most of the major markets. So probably that might sort of speed up the process going forward. So that is what our anticipation is.
Stay with us. Let's get in Samit then to talk about Sterling and Wilson's renewable energy, because they've emerged as a successful bidder for an NTPC project worth about 2,000 odd crore rupees. Samit, give us the details. What does this mean for Sterling and Wilson?
Well, it's a significant order win for the company because of this order win of around 2,100 crore rupees from NTPC. Their order book increases by nearly 66% and now stands at close to 4,500 crore rupees. Now, as this is a domestic project, the margins are also expected to be higher on this side as compared to the overseas projects, which are generally on the turnkey basis. Now, also the risk for this domestic project is lower because it does not include procuring modules and that is not a part of the contract. So the risks are lower for Sterling and Wilson from this project. Also, the company is in process to win or the bag the Nigerian order. Now, they have already signed the MOU for the 1.5 billion order. It's just the financing that they are working on, and as soon as the company gets this order, their order win target is also expected to come back to the normalized run rate of around 8,000 order wins per annum, as against the current rate of around 4,000 rupees. Now, brokers are also very bullish on the stock because as the company executes these new large and profitable orders, they are expecting a sharp turnaround in the financials when it comes to the FY24 numbers, and they're also expecting that balance sheet to delever sharply in FY24. Now, do remember the management has also guided that they aim to reduce that debt significantly by the end of the next financial year, that is FY24. So, a lot of positive factors working in favor of Sterling and Wilson. Do keep an eye out for this stock.
Much, Samit, for giving us those details. Meantime, Nooresh, let's get in a view then on the chart. Some of the big drags in yesterday's trading session included from the banking space the likes of an SBI that came under pressure. There was HDFC Bank, ICICI Bank. What does one do with these stocks?
So I'll start off one by one. So State Bank of India has been finding support around that 500 to 515 mark. So if you look at the lows in end of December, it made a low around 499 to 500. The low in February was closer to 510. 3 days back, it made a low around 514. So this remains a critical level. So till the time it holds above 505, we can play for a bounce back back to 560, 570 levels. So at current levels, the risk reward is interesting for a bounce back trade. Next, we go to HDFC Bank. Same is the case out here. It's corrected from that 1700 mark, which was the top when the merger got announced, as well as 6 months before that. And 1530 is the recent swing breakout which we saw. We saw a big gap up move on a single day, a very high volume take. We retested 1530 a couple of days back. And from those levels, it should again play a bounce back towards 1620 to 1640 and then 1700 also. The risk reward here is also interesting. The last one, ICICI Bank, actually was one of the stronger ones yesterday. The stock did not fall much in the morning and almost closed in the positive by 20 bips trade. So out here, the base is a little lower at 800 to 790. But the stock has recovered towards the 830, 35 levels. So this is a relative outperformer in the last few sessions. This could again bounce back towards 870 to 880 levels. So expecting all these three names to actually make a 5 to 7% bounce back in the near term.
Okay. Reliance and ICICI Bank are two stocks where brokerages today have come out with reports indicating that they are the ones which are easy to understand, clear bet on India, and a complete play on complete proxy on what's happening in India. So Pankaj, I won't get into ICICI Bank with you. I understand and I respect your compliance, but we can definitely understand Reliance. Why is Reliance underperforming? Even though their businesses or business verticals are firing full cylinders, the stock is just going down as if there is no tomorrow. What is bothering the market?
So I think a couple of things, Nikunj. One, obviously, is that if world is going to probably experience a slowdown or an accelerated slowdown, I think the GRMs could be under pressure. So there is an anticipation that the GRMs may not really sort of hold those levels. And I think telecom is another business. What we are seeing is that probably the tariff hike is really not sort of panning out on expected lines. While we might see data growing from say about 22 GB per month to say 50 by 2026-27, but that's probably not a good enough lever to sort of pull that business vertical up. And I think on the retailing side, our sense is that probably given the higher base, we may not really experience the kind of a double-digit growth what we have seen. So from that perspective, I think a lot of businesses are still sort of looking subdued, and which is why I think Reliance is sort of experiencing the kind of pain in terms of price performance. And I really do not see that sort of changing anytime soon with the global perspective still sort of challenging. And on the telecom side, probably we might see some bit of a higher data consumption given the upcoming IPL. But until the time tariff hike does not happen, I don't think that is going to sort of provide much of a help to the overall performance of Reliance Industries.
Okay, meantime, let's also just take cognizance of those fresh brokerage notes as well that we highlighted that came out earlier this morning. There's also BofA's note on Tech Mahindra. They've actually downgraded the stock to underperform from a buy rating with a target price at about 1,040 rupees, saying that they've lowered the EPS growth. They're saying 12 to 18 months before the CEO change could actually start benefiting the company, and lower spending in sectors like high tech and telecom as well could be a bit of a drag for Tech Mahindra. Pankaj, just isolating Tech Mahindra within the entire IT space, do you see some of these concerns? And in light of that, which are your top picks within IT?
So when you sort of look at, say, Tech Mahindra specifically, one is your 40% contribution, which is coming from communication vertical. I think that has been a sort of a historical underperformer compared to most of the other tier one names. And we still don't see that segment sort of doing much, while the stock is trading attractive at 12, 13 times. But till the time we get enough clarity in terms of growth being on a higher side or lower double digit, I don't think this stock is going to sort of do much, and which is why we have a hold rating on the stock. What we sort of like is, again, tier two, probably names like, say, LTI Mindtree or Coforge, or something like smaller company names like, say, Newgen Software, where I think the management is confident of delivering 20-22% kind of our top line and bottom line growth.
I'm just going to spend a minute and talk about Infosys here, and then there is a view coming from Neeraj Dewan on ITC. And Pankaj, Infosys has seen two big exits, and we've not heard any big replacements. TCS has seen one exit. Is this the season of IT exits, is it? Because every large company is suddenly seeing a lot of exits.
Actually, Infosys has historically seen higher level of top level exits, and which is why compared to TCS, the stability at the top has been sort of missing for quite some time. And which is why our sense is that despite all the sort of good historical numbers, probably Infosys will sort of continue to sort of lag compared to TCS. And it's still sort of trading at a marginal discount to overall TCS PE multiples. And TCS overall, I think our sense is that probably we may not see that kind of a challenge, especially from the growth perspective, because the new management is still sort of guiding for $50 billion kind of a revenues. So 9% kind of a growth is not a major thing to sort of deliver. I think Infosys would have a lot more challenges given the fact that you need to get new management, and then they'll put up their strategies for chasing growth. So I think, and on top of it, when you sort of look at US markets, I think things are getting challenging there. So I think some total IT as a sector is still sort of looking quite soft or subdued for some period of time.
He's looking a tad bit soft or subdued, at least for some period of time, given the headwinds, especially around the BFSI vertical and the transitions that have been happening at the leadership level. But let's get you some fundamental ideas now. These are coming in from Neeraj Dewan as well as Sanjeev Bhasin, and they are talking about their top fundamental bets at the moment.
There's some improvement in rural consumption, so that may also help some of the consumer names. But when you look across, though, they may be defensive right now because like you rightly said, some pain may be over for them, and rural demand is also picking up. But then valuation-wise, you don't find them that attractive. So they already be trading at 45, 50, 55 times on a forward. So that valuation comfort doesn't come. But definitely they can be treated as a defensive right now, and you can harden them till market choppiness, market volatility gets over. Still again and again that one name, this ITC comes back because valuation-wise, that ITC is still attractive. Their food business, the non-cigarette business is also showing good traction. So I think that is one name which still comes in that category where valuation comfort is also there. So we've seen some correction also happening there. So that can be one name which can be looked at.
I continue to see Bosch has hit new highs. By the way, 22,000 is coming. You can add a Motherson Sumi on the OEMs. And I think Eicher and Maruti will lead from the front. Bajaj is a very, very big outperformer along with Mahindra. But I think some of the OEMs can outperform from here.
So those were some of the top fundamental bets coming in, but a few brokerages actually managed to meet Shree Cement as well, and they are coming back a tad bit positive about how the demand momentum is at the moment. Let's go across to Vinny to understand what exactly are the key takeaways from this management meet. Vinny?
Absolutely, the management of Shree Cement met with MK, and there are the key highlights that are coming in and what are going to be the key focus areas for Shree Cement over the next few years. The most important one is going to be that they are going to be lowering the pricing gap that they've seen with the peers, and this is mainly going to be through the branding, marketing initiatives that the company will take, and also increase their share in premium products. So lowering the pricing gap, focusing on branding, marketing, and increasing their market share is going to be a key focus area as well. Cost optimization initiatives that will continue from the management as well. They will maintain their cost leadership position is the word that we're getting in and coming in from Shree Cement in the note by MK as well. Other than that, what the company also highlighted is that they're going to be maintaining volume growth that will be higher than the industry rate in terms of the volume growth as well. So higher than industry volume growth, mainly to gain market share and better operating leverage will be something that will be supporting the volume growth of the company. So they're aiming volume growth of around 1.2 times to 1.3 times the industry over the next few years. That's what the management is highlighting. And overall, they expect the industry demand to report around a 6 to 8% CAGR growth as well. So yes, that's a positive sign that we're keeping an eye out on as well. Other than that, given that, they are increasing the share of rail mix and lowering the lead distance, raising the share of green power as well. So what MK is expecting that this will lead to Shree Cement actually maintaining their cost leadership position as well, and obviously focusing on narrowing the pricing gap by rupees 20 to 25 per bag versus the peers. With the peers is something that we're keeping an eye out on. MK is maintaining their hold rating given a target price of 25,000 rupees per share.
Thanks very much, Vinny. We'll be watching out for that stock in trade, but not just that. Overall Realty as well, it's on the radar. Morgan Stanley has listed out some key takeaways. Let's understand then what exactly the management has to say and what Morgan Stanley believes are the prospects for the company. Vamakshi joins in with those details. Morning, Vamakshi.
Well, morning. Motilal Oswal has actually met up with the management for Oberoi Realty, and in fact what they're highlighting is that the key residential projects are expected to be launched in FY24. The much awaited launch of the Kolshed Road project in Thane, which was earlier scheduled for the fourth quarter of this year, could be spilled over into the first quarter of next year. But they believe that there is a strong possibility of a new tower launch at Elysian, which could actually help them in offset the delay. 360 West should also see bookings of nearly 3 to 4 units, and that could actually lead to a total pre-sales of 1,100 crores in the fourth quarter. Now, as far as the leasing portfolio is concerned, they're expecting to receive a OC for Commerce 3, which is in Goregaon by the end of FY24. And further, Morgan Stanley, which has leased out nearly 50% of the total area, has commenced fit-outs and is likely to start paying rentals beginning in FY25. In fact, Oberoi Realty is expecting to finish complete leasing of the area by FY25, and at full occupancy, Commerce 3 has the potential to generate nearly 600 to 650 crores of annual rentals beginning FY26. The Borivali Mall is on track to commence operations during October and November of this year itself, and in fact, Inox has already come on board as one of the anchor tenants for the Borivali Mall. The mall is expected to be stabilized by nearly FY25 and can generate annual rentals of 250 crores. Now, annuity rentals overall for the company are projected to surge to nearly 1,200 crores by FY26 from 300 crores in FY23. So overall, when we look at it, the launch of the Thane project, new product additions, the healthy traction in 360 West, as well as significant scale up in rentals are some of the key re-rating triggers for Oberoi Realty.
All right, thanks very much, Vamakshi, for giving us those details. Moving right on then, GE Shipping as well conducted their first investor day, or one of their investor days. Let's understand what some of the key takeaways have been and what exactly the company is expecting down the line. We've got Sharad here to walk us through those details. Sharad?
Well, yes, important management meet of GE Shipping was there over the weekend, and the important thing is that the offshore division is expected to break even by FY25 as the entire fleet gets repriced. Now, apart from this, management also stated that the offshore division's recovery is unlikely to be dented because of the recent correction seen in the crude prices. Apart from this, they have also stated that the new order activity has actually picked up when it comes to the tankers over the last 2 months. And also, the industry is still expecting a negative global fleet growth in FY24. Even after this, they are also not keen on selling ships even when the asset prices are at the higher levels. Now, overall, the brokerages are expecting the company is expected to have a free cash flow generation of 3,500 to 4,000 odd crore rupees. And looking at the rates itself, especially the tanker rates, they are expected to be strong going ahead. And for the dry bulk rates, they are also expected to pick up in the second half of FY24. The stock itself is down 19% from December highs. And if you look at the brokerage stake, we see BNK Securities has maintained a buy rating with a target price of 933 rupees per share, while for Ambit Capital also they have maintained a buy rating with a target price of 800 rupees per share.
Okay, so that's the take coming in on GE Shipping. The volatility in the oil prices is not expected to have a big impact, and they're expecting their offshore unit is going to break even by FY25. But Pankaj, wanted your take if you track some of these counters closely as far as the cement pack is concerned. Yesterday, we saw a bit of a pressure on India Cements, which was down about 5%. And this morning, there was this Shree Cement analyst meet wherein MK was talking about the key takeaways as well. How are you looking at the entire cement sector?
So in the cement space, Q2 was one of the worst quarters, and Q3 we had seen some bit of an improvement in the EBITDA per ton, largely because the power and fuel cost had sort of gone up from 700 rupees per ton to say 1,000 or even more than that. Now, our sense is that in Q4 we might see some bit of a respite or some bit of expansion of 150 to 200 rupees EBITDA per ton. And largely because of the lower raw material prices, because the cement price hikes have still been sort of muted. Now, overall, our sense is that the demand will continue to grow at 6-7 odd%. Plus, I think the capacity growth could be slightly lower than that. So that might lead to slightly better prices. So there could be some bit of improvement what one can expect. But I think we still don't see, till the time price hikes do not really come into picture, we really don't see this space sort of outperforming compared to the rest of the market, despite the fact that some of these stocks are trading quite attractive compared to historical valuations, what we have seen. So bit relief in Q4, but not good enough for the entire sector to sort of out.
Your take, any names from the cement pack that you would want to highlight on a technical basis that look attractive?
So I would believe Ultratech Cement is the top candidate over here. The stock looks very attractive. In fact, the stock trades at a premium of almost 1% as compared to most of the other names. And in fact, even the benchmark Nifty, which is trading at a premium of just I think 40-50 points, I think less than 50 points on yesterday's closing. So that itself is one indication that traders are absolutely fine in rolling over positions on the long side for Ultratech Cement. And then I think even Shree Cement has been showing some good strength at the 25,000 odd mark. So apparently the last 1 month, Shree Cement, Ultratech Cement, and most of the other large cap formidable names, they've gone through more of a time-wise correction. I believe that whenever these kind of time corrections have happened, it's actually resulted to the stocks breaking out on the upside, because in the tough phase of the market, if these stocks have managed to withstand most of the volatility, then there's always a chance that these stocks would tend to outperform in the phases when the markets become a lot more stable. So I believe Ultratech Cement and Shree Cement are the two names which I believe are short-term should concentrate on. I would expect at least a 5 to 7% rally on these stocks from current levels.
Okay, meantime, within the auto space, Kunal, what's the outlook on the charts of Maruti? Are you seeing some sort of a decisive move, and Tata Motors?
So Tata Motors is a bit range bound. The stock has not done, I would say, pretty much in the last 1 month. I think 400 to 450 approximately has been a broad range for Tata Motors. The stock tried to break below that 400 mark, I think a month and a half odd back, recovered quite smartly, came back over that 450 odd levels, or very close towards breaking that 450 mark, but then it failed to cross over those levels convincingly, which means that the stock is going through a time-wise correction. I believe a better trade could probably emerge once Tata Motors breaks past about the 450 mark. That's where I believe that the momentum would shift back again into the stock. Now, Maruti is a case, it's a bit of an exceptional case because the stock has been correcting quite sharply. It was one of the few large cap auto names which had actually not broken past about the life high levels initially. But what's happened is in the last leg of this price downtrend for Maruti, where the stock has come back towards 8,300, 400 levels, the indicators on yesterday's closing have entered into an extremely oversold territory. So on one front, the prices may look weak, the chart patterns are structurally showing signs of negative, but then just based on the fact that the indicators are oversold, I would expect a very strong bounce in Maruti as well. So I think from here on, if I have to bet on from a contra perspective, then Maruti could be a play on the upside. Would look out for at least a 200 to 400 point bounce on the stock from current levels.
Okay, so short-term bounce on a contra basis, if you want to play Maruti, is a good bet. But this is a stock pickers market. That's the word coming in from Gautam Shah, the founder and chief strategist at Goldilocks Premium Research as well. Listen in to his top ideas.
IT is one basket that will try and hold the market, every time it comes close to support levels.
If I put a gun to your head and say, Gautam bhai, no sell calls. You have to buy a stock. And there's a gun to your head. What would you say? Shoot me, or you'll give me a name?
No, there's always a name, yeah. I think, so I would say L&T. I think capital goods has been our favorite all along. I see it as a 3-year, 5-year story. So these market dips are a great opportunity to buy into capital goods. Look at what Cummins has done, ABB, Siemens, L&T. I think they are great buys from a long-term perspective. The moment the market stabilizes, these stocks will start making new highs once again.
Saying this because there is a gun to your head, or you would have said these names if there was no gun to your head also?
Only because there was a gun to my head.
Okay, I'll remove the gun now. Now tell me the names.
Pretty much the same names, but I would also add the PSU names. I think we like the setup of NTPC, Coal India, Power Grid. I think I love the way these stocks have behaved in these difficult times. There is earnings, there is dividend yield, there is under ownership. And I think they could do really well. I think the beauty about gold is that anything happens in the world, on the negative side, gold is the first to go up. And we've just had too many developments in the last 1.5 years, or rather since the COVID times. And with this development around SVB, we've seen this $100 move on gold. It's already at 1915, 1920. I think it will get past 1970 in the near term and eventually move past lifetime highs of 2017. So there is 7, 8, maybe even 10% upside on gold and about 15 to 17% upside on silver. And we strongly recommend topping up on both these precious metals at current prices and on any small decline.
DLF. Pankaj Pandey, DLF hit the headlines last week after they announced that their real estate worth 7,000 crore was sold in 3 days. Do you think DLF is a standout real estate winner, or what's happened to DLF in terms of a response is the real story as to what will happen with other real estate developers also?
Nikunj, when you sort of look at real estate as a segment, calendar year 22 for top 7 cities, we have seen the highest sales after, say, a period of 8 to 9 odd months. But the challenge is that we have seen about 225 bips kind of a hike in home loan rates. So home loan rates are have touched 9% and crossed even 9% for some of the buyers. Now the challenge is that when you sort of look at for real estate, sentimentally till the time interest rates do not come down, our sense is that probably this space may not really sort of do well. Our top pick in this space is Brigade Enterprises. I think this is one company which has very little leverage on the residential side and has been sort of doing very well both in terms of execution and also has got triggers in terms of monetization of the hotel properties as well. So I think that is our topic. But like I said, till the time we don't really get a sense that the interest rates are going to sort of soften from current levels, probably real estate, despite giving or delivering one of the highest sales in the last 8-9 odd years, may not do so well. A lot of other positives are also sort of panning out when you sort of look at the share of organized players. Now that is crossed 20%. So I think you have structural positives in place. I think what is required is probably the softening of the interest rate for this entire space to outperform.
What price point, Pankaj Pandey, will fintech and consumer tech stocks, they become a buy? The underlying thought here is interest rates come down, valuations go up. Very simple. Some of the consumer tech and fintech companies in India have cash, which means there is no winter or summer or a monsoon or cloud for them.
Well, Nikunj, the only expensive space what we like is capital goods. I mean, you look at companies like, say, for example, ABB Siemens. So those are sort of trading in excess of 50 times on a forward basis. Largely because when you sort of look at the kind of capex, I mean, FY18, if I recollect it right, the overall government capex was 2.6 lakh crores. Now that has jumped to about 10 lakh odd crores. So that is one space, I think, where structurally things are a lot more positive, despite the fact that things have been expensive. The rest of the expensive names, in fact, we have been sort of, I mean, be it paints, be it even some of the FMCG names or some of these names like, say, for example, Relaxo. I think we have moved out some of these names from our portfolio. And I think largely, challenge always is that when the visibility for profitable growth is still not there, so the challenge always lies in terms of what to sort of ascribe in terms of value. And that is a classic challenge with most of the fintechs or even the expensive names. Even for FMCG, I mean, while the companies might be trading at 55, 60 times, it's a good place to hide. But at best, you can get lower double-digit kind of a growth. So from that perspective, I think capital goods or the MNC capital goods as a space, despite being expensive, is a attractive proposition, given the fact that next 4-5 years, I think the government template of higher capex is likely to remain intact.
So getting a sense as to what our chartists are picking out as their top mid-cap bets. For now, the pre-open rates around the 17,050 mark, up 1/3%, and for the Sensex, up about 200 odd points. That's the rupee as well, which is at about 82.5 to the USD. So let's find out, Kunal, your top mid-cap strategy.
Avan, it will be a buy on Federal Bank. I think that stock has made a very strong comeback, trading at 128.29 on closing yesterday. Recovery quite strong, bullish candlestick pattern for Federal Bank on the closing basis yesterday. So on the back of it, I would expect a steady recovery from here on. 135 could be an immediate target for traders who are looking at a buy. Stop loss 126.
Okay, what about you, Nooresh? What are your top mid-cap bets this morning?
So continue to like Indian Energy Exchange, IEX. The stock has been holding on well even in the current markets. The stock is around that 150 mark. The swing highs for the last 3 to 4 months of this consolidation between 130 to 152 are around that 152 mark. The stock also recovered well yesterday. Expecting this to go towards 170, a stop loss to be kept at 145.
All right, let's get a move on then and understand why banks are in the spotlight. Credit Suisse may have got that lifeline from UBS. That's one category of the crisis-hit bank bondholders, which are set to see about $17 billion wiped out. So what exactly are the implications of this on the banking industry? How is it different from what we've seen happen back home with Yes Bank? Let's get in Pankaj. He joins in with that explanation. Pankaj.
Well, thanks, Avan, for that. It's a very interesting talking point that's hitting the market as far as mid-cap banking names are concerned. UBS buyout will lead to 81 bonds write-off as far as Credit Suisse is concerned. And that's one of the key global talking points. Remember, equity holders will be paid a little bit, which is 40% lower than the current market price, but 81 bond holders likely will not be paid anything great. Now, what essentially this means, I spoke to a couple of global bond holders and they're saying that coupon rates for equity is much higher than 81 bonds. This will definitely have an impact as far as the overall financing is concerned, or risk appetite for these bonds would actually go up globally. Now, APAC has been pretty active as far as these bonds are concerned, and even India has been active in that. In India, you've had a similar episode as far as Yes Bank is concerned when the whole Yes Bank fiasco was going through. However, the 81 market did take a big hit for a couple of years, but now it has finally started to revive, at least for the larger ones. So names like SBI, HDFC, various others, have been going into focus. Now, when we just talk about, what's happening as far as the risk-weighted asset is concerned, you just get a sense that the risk-weighted asset that we are talking about is generally about 0.8% to about 1.2, 1.3% as far as the overall space is concerned. So that's something which the street is talking about. Overall, 81 bonds issuance could see a little bit of higher risk appetite, which means that the yields that they offer could go up, or if mid-tier banks were to raise funds, it could be something which could have an impact on the overall space for 81 bonds in India. So that's something which is a key talking point. It's a part of CD1 ratio, and that's why it's an important trigger that how it actually pans out.
Interesting indeed, Pankaj. Thank you so much for joining in and putting everything in perspective. Let's see how the bond markets in India react to the global news flow as well. But
Pankaj, what is the best trade to bet on given that how crude prices have fallen more than 15% from the recent high? OMCs, Asian Paints, or something else?
I think given the fact that crude oil prices have declined about 14% in the last fortnight, Nikunj, I think the OMCs are a better bet. Be it HPCL, BPCL or IOC. Largely because all three stocks you would find are trading at attractive valuations of 5 to 6 times for multiple. I think there could be some relief on the marketing side for these companies given the fact that crude oil prices corrected. I wouldn't touch paint largely because while the titanium dioxide prices have corrected, but our sense is that given the entry of new players, probably at best you could see 50 to 70 odd bips kind of a margin expansion in Q4 for paint companies, which is not a great number given the kind of a decline in crude oil prices, what we have, or the associated raw material prices, what we have seen. So I think OMCs are looking a lot more better. One, I think they've been ignored for quite a period of time. Then I think they are sort of looking to sort of foray into new areas. I think we still need to sort of figure out what kind of contribution they'll do or new businesses will deliver to their top line. But I think they are a sort of an interesting space given the historical underperformance.
Okay. Nooresh, where does this entire theme of going back to commodity consumers fit in now, given that crude is down, commodity prices are down, markets are reoriented trade, moving out of banks to other sectors?
So in this trade, it's a difficult one. The only one which actually is playing out really well is OMCs, which is where we are trying to see a lot of momentum. So if you look at a BPCL, the stock is now at a 6-month high or almost close to a 1-year high. And the volumes have been good over the last 3 sessions. So I would like IOC in this as a stock which is yet to make that catch-up move and generally tends to be a little late in that move. So I would go with IOC, then maybe in FMCG it could be Brokerage Consumer, which is going to break out a new 52-week high here. So the trade should be to go with stocks which are showing relative outperformance in such a case. The rest of the names I would not be very clear, but these are the names. IOC and the Brokerage Consumer would be the trade.
and Godrej Consumer are two of the stocks that you would recommend at this point of time. But what's the recommendation at the index level? Let's take a look at the index call coming in from our technical experts. Well, as far as Nifty is concerned, Kunal and Nooresh believe that the best strategy is to go hold, while Kush Bora believes that there is more upside available, and that's why he has a buy recommendation. So the consensus seems to be a bit of a hold with a positive bias. That's the take as far as Nifty is concerned. Let's take a look at the Nifty bank calls as well. Similar picture shaping up. Kunal and Nooresh believe it's best to probably just hold on to position, maybe not add fresh ones, but Kush believes that he's a tad bit more bullish. He's suggesting a buy on the Nifty bank at the current levels, and thus the consensus become a hold with a positive bias. For the markets, a bit of a nervous situation because there are big events lined up. So, of course, the FOMC data point is something that will be important. But I think, Nikunj, apart from the 25 basis point hike, or is it flat, I think the more important bit would be the commentary, right? What they say about what's happening to the banking situation in the US and Europe.
I look at it slightly differently, Anisha. I mean, I look at it that what if they increase interest rates tomorrow, it means that Fed feels that there is going to be no collateral damage, or there is going to be no near-term ALM mismatch, because by now they must have really looked at all the books of all the financial institutions. But that also is an indication that inflation, our inflation fear, inflation problem is far from over. So while it would be an endorsement for the banking sector per se, it also is an acknowledgement that the problem of inflation is far from over. But if they increase interest rates, for me that is a bigger endorsement of confidence rather than the inflation, rather than the war against inflation. Because right now markets are worried not about slowdown. Markets can deal with the slowdown. What they cannot deal with is a contagion and a collateral damage to the financial sector per se. So Fed increasing interest rates in my book is actually more positive than negative. If they do not increase interest rates, does that mean that they are under pressure, that interest rates of US economy will not be able to digest a rate hike? Maybe yes, because the last inflation reading is indicating that the inflation trajectory has not really normalized, or it has not really peaked out. So for me, a endorsement from Fed will come if they increase interest rates. Now, markets would say, look, we'll deal with other problems later on, but first, the central banker, the world's biggest central banker, has to come and stamp the fact that they feel confident about the resilience of the banking system per se. First rates will just start coming up on your screen now. You got a 72-point uptick on the Nifty, you got 0.5% uptick on the Bank Nifty. So it's a good start, it's a decent start, and for a change the market breadth is looking charged up. So from the yesterday's low, it's been almost a 200 plus point swing for benchmark indices. 16,800 now is 17,100, almost 17,100. What is taking the markets higher? Now, there is no large newsmaker per se. It has to be in combination of news plus large heavyweights. So you got Reliance, which is up by 1%. ICICI Bank is giving Reliance some company. You got Adani Ports looking strong. HCL Tech looking strong. So is it that turn? Is this that big turn which we've been talking about both at a global level and at a local level? That is something which I think is the most important takeaway for me.
Yes, for now it does look like it's a very smart open. The advanced decline ratio, as you pointed out, 1300 to around 250 stocks declining. The Bank Nifty is also doing its bit, up around 0.4%. Very broad move, because if you look sectorally, there are a lot of sectors actually trading in the green. Nifty Metal is your top gainer, with the likes of Adani Enterprises, Jindal Stainless gaining quite a bit. PSU banking space has also managed to perk up. So you have Indian Bank, Maharashtra Bank, IOB, etc., which have opened with a big thumbs up. But stock specific, there is no big mover as such. You have Sterling and Wilson Solar, which is opened with a gap up of 5% on account of that big order of 2,100 crores that the company has bagged. You also have UTI AMC, which is higher by 5%. Adani Green, Alok Industries, Fluorochemicals are some of the other gains on the top gainers. IGL, remember there was this note coming in from CLSA this morning. Maybe a bit of reaction coming into that. On the losing side, you have names like GAIL, which is down 3%. National Aluminium is also down around 2%. So no big movers as such, but
It's a very, very broad-based move that we are witnessing at this point at the index level. Let's go across to our technical experts to understand how they are tracking the market opening, because we are just around that 17,050 mark for the Nifty, and the Sensex is also up around 200 points. Nooresh, your first trade?
So playing for a bounce back trade on Infosys at 1400, a very small stop loss at 1380. Could expect a bounce back here.
But you, Kunal, what are you strategizing at this point of time? Anything that catches your attention?
So it's ITC. I believe that stock should make a strong comeback for itself after correcting from 394 to 360 approximately. So that's a trade which I would look to strategize.